Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, New York City, we have Granville Martin. He's the Senior Vice President and General Counsel of the Society for Corporate Governance. We also have Heidi DuBois. She's the ESG Director, also at the Society for Corporate Governance. And we're going to take a look at why investors are increasingly interested in ESG investing. Granville, Heidi, it's great to have you both with us at MarketSite. And Heidi, I'm going to kick it off with you. We hear this catchphrase, ESG investing. What exactly is it?
Sure. Maybe we can start with the simplest overview. ESG stands for environmental, social, and governance, and those are really the three pillars that people are focusing on today. Over time, I think what we've seen is an expansion of the world of ESG investing from what you would call value-based investing, or values-based investing, I should say, to value-based investing. So, you know, the market is really honing in on five different types, five different strategies for ESG investing. Number one, SRI, which is, socially responsible investing that really involved elimination or screening out of various stocks that an investor's values would prohibit him or her from investing in. Number two, we would call really best-in-class investing, which involves choosing companies for the portfolio that have the highest scores on various data provider assessments. Number three would be thematic investing, where an investor selects a particular sustainable theme like renewable energy to invest in. The fourth example is impact investing, where an investor is seeking to both from the get-go have a social or environmental positive impact along with achieving financial returns. And then the last segment that I think we'll talk a lot more about today, and where we think the greatest expansion is going to come, is with what we call ESG integration. And what that involves is the incorporation of significant ESG factors alongside a traditional financial analysis. And I think that's where we'll see the growth.
All right, Granville, that's my next question to you. Why do you think investors are increasingly more interested in companies that practice ESG and other social practices?
So let's break that down a little bit. What companies are doing more and more of is systematically trying to manage their environmental and social risks. And that matches up nicely with what many investors are increasingly doing, which is to focus on and understand the environmental and social risks that companies have, how they might affect their business, both in the near term and in the long term. Probably the best known example of investors becoming more assertive in asking companies for clarification on their strategy and what their long-term plans are is climate change. Investors are increasingly focused on climate change because many of these long-term investors, particularly think about the passives and the index providers, are effectively permanent shareholders. They're looking way out into the future, and they are identifying systemic risks to some of the companies that they hold, and they're seeking to engage those companies to understand what their, in this case, what their strategies are for addressing and dealing with the impacts of climate change. So that's one example of systemic risks that investors are focusing on. Another is trying to attract assets under management. AUM obviously is what gets investors focused, and there is there's a lot of evidence, and I think you see this in Edelman's forthcoming investor trust barometer, about what the attitudes of younger investors are with respect to the impact that their money and investments can have. And many asset managers are looking at those attitudes and thinking and asking themselves, how can we attract assets in the context of a massive generational transfer of wealth that's going to occur over the next 20 years, and being more attentive to and fluent in understanding and managing environmental and social risks on behalf of the portfolio companies is something asset managers think is going to stand them in good stead.
And you're seeing this translate into creating shareholder value based off of these trends and other issues.
So ESG with respect to the creation of shareholder value, you're seeing that in areas like consumer products, sustainable brands, really connecting both the products and the brands themselves to more sustainable outcomes and more sustainable practices. So I think that's an area where you do see an increase in shareholder value. There's also the flip side, which I think is really historically the more impactful aspect of ESG and investors, and that is the management of risks that can destroy shareholder value. So think of a large mining company in Latin America that just had a big tailing pond collapse that killed a bunch of people and led to a very significant drop in equity value. PG&E in California has obviously filed for bankruptcy. Another environmental risk. You don't have to dig too far to find a whole series of examples where E&S issues have led to shareholder value destruction. And so it's both an opportunity and a risk equation that ESG investors are seeking to understand.
All right, and we'll wrap it up with you, Heidi, here.
Sure.
What oversight roles do boards and the leadership teams play in being responsible for the evolving ESG landscape?
Yeah, I'm really glad you asked that question, because it is fundamental for both corporations and investors, the role of the board in overseeing E&S risk and opportunity. We recently conducted a sustainability benchmark survey of our membership, and we asked several questions on this topic. And what we saw was that numbers were in the high 70s for both of these questions. Number one was, does the board or a board committee oversee E&S risk for your company? And again, that was around 73% said yes. That oversight did vary. We would say the number one location for oversight would be the nominating and corporate governance committees, which have historically had oversight of government affairs and public policies, so that's kind of a natural progression. Number two that we saw was full board oversight. And then a little bit of a distant third is a specific committee focused solely on ESG. In terms of the frequency with which boards are overseeing E&S risks, our membership indicated in the high 70s, 78%, that their board had addressed or evaluated an E&S risk over the past 12 months. So we definitely see this as a significant development in board roles and responsibilities.
That's certainly encouraging. Heidi, Granville, thanks so much for joining us at Marketsite. And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.